3 days ago, Anthropic's chief product officer quietly resigned from Figma's board. Today, Figma crashed 7%. It's now down 80% from its all-time high. Wall Street is panicking, but here's what nobody's telling you. Sequoia Capital, one of the most feared venture firms on earth, just walked into the open market and dropped $36 million buying this exact stock. One of these two sides is very, very wrong. I'm going to show you with the receipts exactly who. Here's what doesn't add up. Figma just closed out 2025 with its best quarter in company history. Revenue up 40%. Growth accelerating, not slowing down, accelerating from Q3 to Q4. They crossed $1 billion in annual revenue for the first time ever. Net dollar retention hit 136%, the highest it's been in over 2 years. In plain English, their existing customers spent 36% more this year than they did last year, and the stock is down 80%. Record business, broken stock. That gap closes one of two ways. Either the business breaks or the stock re-rates. Stick with me, because what I'm about to show you is how this disconnect happened, and more importantly, who saw it coming. To understand why this stock is at $18, you have to understand how it got to $143 in the first place. Figma went public on July 31st, 2025. IPO priced at $33 a share, one of the biggest IPOs of the year. Day 1 opened at $85, closed the first day at $115.50, a 250% gain. In one trading session, financial media called it the return of the IPO market. A historic debut. Here's what they didn't put on the front page. Figma's IPO had something almost no IPO has: a performance-based early lockup release. Translation: if the stock hit certain price levels, insiders could start selling 36 days after the IPO, not 180 days. 36. The stock hit those levels. Insiders sold into the retail frenzy. The CEO filed a pre-planned selling agreement 4 days after going public. Over the following 6 months, the stock bled from 143 down to where it sits today. This isn't a business failing. This is the completely normal unwinding of an IPO that was priced for euphoria and sold into reality. The business didn't break. The stock just got honest. Now let's talk about this week, because today's 7% crash didn't come out of nowhere. 3 days ago, April 14th, the information broke a story that Anthropic was building an AI design tool that could compete with Figma. That exact same day, Mike Krieger, Anthropic's chief product officer, the guy who co-founded Instagram, resigned from Figma's board. Stock dropped 6% on the news. 3 days later, today, Anthropic launched Claude Design. Stock dropped another 7%. So think about what you just heard. A board member of Figma quits to go compete against Figma. He publicly announces it, and the smart money, we'll get to the filings in a minute, was already buying before any of this went public. This wasn't a surprise to anyone on the inside. Everyone who needed to know already knew. The panic you saw on CNBC today, that's retail finding out late. And the most important question, the one nobody's asking, is why the smartest investors on earth kept buying anyway. Let's start with what Figma actually is. 95% of the Fortune 500 already runs on Figma. Market share in UI and UX design, somewhere between 80 and 90%. That's not a market leader. That's a near monopoly. But that's not the real moat. The real moat is this. Their gross retention rate for customers paying over $10,000 a year is 96%. Let me translate what that means in human. Once a company signs up for Figma, they don't leave. The churn rate is a rounding error. It's not a tool, it's infrastructure. Designers live there, developers live there, product managers, marketers, entire teams. They all build inside this one platform. 76% of Figma's customers use at least 2 different Figma products. You don't rip that out of a company because a chatbot can draw a landing page. Here's how you know the moat is real. Follow the enterprise spend. Figma now has 67 customers paying more than $1 million a year, up 68% year over year, in a market everyone's calling saturated. And look who's actually using it. About 30% of Figma's user base are developers and engineers inspecting designs in something called dev mode, translating them directly into code. 2/3 of Figma's 13 million monthly active users aren't designers at all. They're product managers, marketers, founders, engineers. This isn't a design tool for designers anymore, it's the operating system for how software gets built. Keep that idea in your head, because it's exactly why today's news, the Claude Design launch, isn't what Wall Street thinks it is. Now let's talk about the thing that crashed the stock. Anthropic launched Claude Design. Simply type a prompt, get a prototype. It's real and it's impressive, and the market treated it like a funeral for Figma. Here's what every headline missed. Number 1, Claude Design launched as a research preview, not a shipped product, a preview. Number 2, read Anthropic's own press release. Canva is named as a partner. Claude Design exports to Canva, exports to PowerPoint, exports to PDF. It's not replacing the Figma file, it's feeding into the existing ecosystem. Number 3, and this is the big one, it's built for people who never open Figma. Founders, marketers, PMs, different user, different job. And here's what an honest designer will tell you. Large language models are genuinely unreliable at editable design work. Prompt an image, it looks stunning. Try to move a single button 3 pixels to the left without breaking the entire layout. Watch what happens. Figma doesn't win because it can draw. Figma wins because when 10 people edit the same file at 2 in the morning, nothing breaks. Claude Design doesn't touch that. Not today. Probably not in 2026. And here's the part nobody is pricing in. 95% of the Fortune 500 uses Figma, but only 24% of the Forbes Global 2000 pays Figma more than $100,000 a year. Think about what that means. Figma is already in the building at almost every major enterprise in America. They don't have to go sell to anyone new. All they have to do is convert the free seats, the starter seats, the single designer seats into enterprise-wide deployments. And the Q4 numbers prove they're doing exactly that. Net dollar retention is 136%. Every $100 of revenue became $136 the next year, without adding a single new customer. This is how the analyst price targets get to $50, $65, $85 a share. It's not a stretch. It's just math on top of a customer base they already own. And then there's this. Figma isn't pivoting to AI. They already are an AI company. Their AI product, Figma Make, grew weekly active users 70% in a single quarter. 75% of paying customers who spend over $10,000 a year are now using Figma's AI tools every single week. That's not adoption. That's addiction. They spent $200 million to acquire an AI imaging platform called Weavy. Rebranded it Figma Weave. It's already running in production at DoorDash and at Lyft. NVIDIA used it to build the keynote at CES. And next month, Figma turns on consumption-based pricing. Every customer who burns through their AI credits starts paying per use on top of their seat fee. That's a brand new revenue line, activating inside a business already growing 40% a year. Here's the punchline. Figma uses Anthropic's models. Figma uses Google's models. They don't pick a winner in the AI war. They monetize all of them. You're not buying a pickaxe. You're buying the general store next to the mine. Let's zoom out. Where does Figma actually sit in this landscape? Adobe, the incumbent leader in the space, is worth over $200 billion. Growth in the single digits. A per-app pricing model the market keeps worrying won't survive. Canva, still private, last valued around $50 billion. Anthropic just raised at $380 billion. Some reports say the next round is at $800 billion. And Figma, $10 billion. Growing 40%, dominant market share, trading roughly 20 times cheaper than Adobe. I'm not saying Figma deserves Adobe's multiple. I'm saying the current spread isn't consistent with the underlying numbers. The market is pricing one of these companies wrong. History suggests it isn't the incumbent that gets re-rated. So if the business is this strong, why is the stock this low? Because nobody's looking at who's buying it. February 23rd, Sequoia Capital, the venture firm that funded Apple, Google, WhatsApp, Airbnb, Stripe, NVIDIA, walks into the open market and buys 1.47 million shares of Figma, $36 million, in cash, on the tape. This isn't an IPO allocation. This isn't a private round. This is one of the most successful investment firms in the history of capitalism, writing a $36 million check at public market prices. 2 days later, a director-affiliated fund buys another 500,000 shares. Cathie Wood's ARK funds have also been accumulating Figma through Q1. And then the Wall Street analysts, 10 firms cover this stock. Every single one of their price targets sits above today's close. The average target is $50.50. That's 108% from here. Piper Sandler's target is $85. Smart money doesn't announce itself on Twitter. It shows up in SEC filings. And the filings this quarter are telling one story. And here's the anchor for everything I just told you. In 2022, Adobe tried to buy Figma for $20 billion. European and UK regulators killed the deal in late 2023. Figma's entire market cap today, $10 billion, less than half. Let that land for a second. One of the most disciplined software buyers in the world, a company that only writes checks it's certain about, was willing to pay $20 billion for Figma 4 years ago, when it was private, growing slower, less than half the revenue, and none of the AI products it has today. Today, after $1 billion revenue year, 40% growth, and customers who will not leave the platform, you can buy the entire company on the open market for less than half of what Adobe tried to pay. And the guy running it, Dylan Field, still holds 74% of the voting rights through super voting shares. He turned Adobe down twice before he said yes. He's not selling, he's building. Fair warning, every thesis has risks. Here are mine. 1. Figma is not profitable on paper. $1 billion in revenue and a $1.25 billion loss last year. Most of it is stock-based compensation for employees. It's a real cost. It dilutes shareholders every single quarter. 2. Margins are getting squeezed. AI infrastructure is expensive. Management guided operating margins down for 2026 while they invest. That's going to look ugly on an earnings call. 3. The competition is real. Not just Claude Design, Google Stitch, Microsoft Designer, Lovable. If any one of them actually cracks the professional designer's daily workflow, this whole thesis falls apart. But here's the honest read. At $18 a share, the market is asking you to take that risk. At $140, it wasn't. So here's where we land. Figma is the category leader in an industry that isn't going anywhere. 95% of the Fortune 500 operates inside the platform. Customers don't leave. Revenue is accelerating. Their own AI products are scaling. A brand new revenue stream turns on next month. Sequoia is buying. Directors are buying. Cathie Wood is buying. Every single Wall Street analyst has a price target above today's close. And retail, scared out of a perfectly good asset by a headline about a research preview. Adobe tried to pay $20 billion for this company 4 years ago. Today, you can own a piece of it for half that price. Record business, broken stock. That gap never stays open. So if you enjoyed the video, make sure to give it a like and subscribe if you aren't already. It really helps the channel grow since we are brand new. Don't forget to leave your price targets in the comments. Is Figma going to the moon or dying with the rise of Anthropic?